Hello, welcome to AleaSoft webinar. My name is Alejandro Delgado, Technical Director of AleaSoft and Associate Partner of AleaGreen, and thank you for joining us today to the webinar with the topic Prospect for the Energy Markets in Europe, Renewable Energy Development, Forward Markets and Hedging. Our first speaker today will be Oriol Saltó, Data Analysis and Modeling Director of AleaSoft and Associate Partner of AleaGreen, that will analyze the evolution of the European energy markets in these uncertain times. Then we have two speakers from OMIP and OMIClear that will talk about the importance of forward markets for the renewable energy development. They are Jorge Simó, COO at OMIP, and Pablo Villaplana, COO at OMIClear. If you have any questions at any time during the webinar, please use the Q&A menu and we will answer them after the presentations. And now, I hope you enjoyed the webinar. Oriol, please, you can share your slides now.
Thank you, Alejandro. Good morning, everybody. We are back from the summer break of our monthly webinars, and wow, they have been very exciting weeks. Our last webinar was in mid-July, exactly 9 weeks ago, and we will see all that have been happening during these 9 weeks. In some graph, we will be comparing how we are right now and how we were then. Maybe in some comparisons, we will see that we are more or less at how we were at that time. But in between, very interesting things has happened. So I'll start right away because I have a lot of things to show. I, as usual, focus on the first part of the content of the webinar, seeing how the energy markets have been evolving lately and looking a little bit into the future. To begin, just a few words very quickly about AleaSoft in case you don't know us. In AleaSoft, we offer forecasting services for the energy markets covering we offer forecasting services covering all the energy markets in Europe. After the summer break, I lost a little bit the fluency that I have with my script. Our forecasting services cover any variable, any time series that can be interesting for the energy sector, obviously demand and price for the energy markets, but also all the variables that impact electricity demand, and the prices like temperatures, weather conditions, renewable energy production, socioeconomic indexes, fuel prices, etc. Anything that can be related and impacting in some way the energy markets and their prices. The methodology that we use for the forecasting is our own methodology developed by ourselves specifically for forecasting in the energy sectors. The 3 main points that we always like to stress about our methodology is that it is a completely scientifically based methodology. It keeps consistency and coherency from delivery to delivery. So we keep consistent. We keep our forecast consistent over the time, so giving confidence and robustness to the forecast that we provide to our clients. And what we can better say than we have been using this methodology for 22 years. We are close to say 23. Next month we will say 23 years, starting in the electricity Iberian market, and now covering all the electricity and energy markets in Europe. As always, we start with fuels and CO2, and I always like to start with this historical perspective of the oil price. Oil price is kind of the global index that tells us how is the global economy going, and back in March, we reached the highest prices that we had since 2008. We didn't reach that level of prices, but basically we are there. But since then, we didn't break the previous record, and right now we are in a downwards trend. If we focus in the last week and last month, we already saw in mid-July. We saw that we changed the trend in the oil price, and basically during these last 9 weeks, the price has kept going down. Basically, due to the uncertainty on how the global economy is going to evolve in the following month. Recession is starting to become real, let's say, in some of the most important economies. Producers, the countries that produce oil are trying or are proposed to agree on cutting or reducing the production in order to at least stop the declining of prices, but at least for the moment it's not been enough. Gas prices, on the other hand, are completely at their highest levels. In mid-July, we were seeing how, due to the disruptions of oil flows from Russia, that it's the main provider for gas for a lot of European countries, that was bringing the prices really high. And by the end of August, when the Nord Stream flow just completely shut down, at first they say that was due to technical reasons. Then they said that it was due to the trade sanctions that Europe or the European Union is putting on trades with Russia. So basically, as the geopolitical tension is there, it's very uncertain how the gas flow from Russia will keep going or no during the winter. That it's the main situation that we are facing right now. How will the winter go? If mainly if it's a really cold winter, that it's when gas demand is really important. Right now we are again highest prices, historical highest prices were reached during by the end of August. Right now we are still at very historical high levels of the prices. CO2, on the other hand, we knew that since the beginning of the war last February, prices have been oscillating with high volatility, but within this range between 75 euros and 90 euros. Lately, what we have seen is that the highest prices were reached again, but then a drop in the price continued. So basically, we are still not seeing the recover of this historically upward trend of the prices. Probably what we are going to see right now is even higher volatility, but as the situation of the energy crisis is not really changing or really seeing an end, probably we will not see this historically upward trend recover. At the long term, we know that this is a market that it's designed to keep the prices going up in order to incentivize decarbonization. But with the uncertainty of the energy crisis, probably we will not see these prices going up again. And now moving to the electricity market, I will not have time to go through all the markets, but as usual, I will show our online platform, and I'll take the opportunity to show you one interesting things about the gas prices. If we compare let's say the European benchmark, that is the Dutch hub, the TTF price, and compare it with the Spanish price of the MIP gas, we are going to see how they were if we put some perspective, let's say since the beginning of 2021. Okay, here we can see how these prices were historically have been basically the same. TTF has a lot more, really a very high volume compared to MIP gas. So basically MIP gas was following the price of the TTF. There are some discrepancies here. We can see January 2021, this peak in the MIP gas prices were due to the Filomena storm with really cold snap in the peninsula with really low temperatures and very high gas demand. But basically, when the energy crisis really worsened, we can see how TTF prices now are clearly, very clearly above the prices, the gas prices in Spain. This is basically TTF prices are basically pipeline prices, and most of the pipeline gas in Europe, in continental Europe, comes from Russia. So basically, disruption of the flows, less gas from Russia means higher prices. While in Spain, we have a lot of regasification powers from LNG. So basically, with higher supplies, we are able to get lower prices. That's it. Interesting things that you can see with our online platform. Going back to our slides. Obviously, we have a lot of reports analyzing any factor related to energy markets. You can see a list in our website, and just trying to see how they are globally. The electricity market prices are globally behaving in Spain. Comparing the price in June, that was the last price that we saw in our webinar in mid-July, compared to the prices that we have in August, that is the last complete month. Basically, the prices have doubled. So if you make the average of all these markets except Spain, you get exactly 100.0% increase in the price. So basically, prices doubled. Mainly, the highest increase was from June to July, and then July to August, prices increased even further. Spain and also Portugal is the different one. You can see that, in fact, we had a decrease of close to 9% in the price. This is due to the Iberian exception. But if to this market clearing price, we include on top of that the adjustment price, the compensation that the demand has to pay in order to compensate the gas power plants, because they are getting lower market prices related to their costs, so they get a compensation depending on the gas price. Even adding this adjustment price, it's called in that way. Prices is this dashed line. Prices are clearly below the prices of the rest of the European electricity market, and that was one of the goals of this mechanism. Limit the gas price that the power plants are selling to the market in order to get lower prices for the consumers. And these are the daily prices for the last months in the beginning of July, and you can see how well prices have been above 200 euros megawatt hour, really high prices, and most of the time even above 300, reaching 700, close to 800. So really high prices. Spain, on the other hand, it has a cap on the gas price, basically a very stable price. If we add the adjustment price, that's more or less what most of the demand has to pay at the end, still getting clearly lower prices than the rest of the markets. And let's see now what the forward curves in the futures markets are saying. As we are comparing the forward curve that we saw in our last webinar, so 9 weeks ago, from the one that we are seeing today, or basically yesterday. For the Brent oil, basically we are seeing no differences. This is basically because the declining of the spot prices are basically following what the forward curve was saying at that time. So basically, as they are following more or less what was expected by the market agents, basically no changes in the forward curve. Long-term equilibrium prices around $70 per barrel. For the TTF gas, it can look like there's been no much differences. That's because, as I mentioned, comparing where we were 9 weeks ago compared to where we are now, we are more or less at the same price levels, but in between we have reached very much higher prices. Right now, the most interesting things comparing these two forward curves is that the largest increase is in 2023, or the last half 2022 and half 2023, where the prices increased by 26%, while the rest of the years the increase has been lower. This is basically delaying the return to this historical equilibrium level. So basically, if we were expecting prices going back in 25, right now we are delaying it 2026, 2026 probably. So basically something that we have been seeing in our monthly webinars, how this return to the equilibrium prices at the long term, to prices at least similar to the ones we had in the past, this return is being delayed. And this is, as the crisis advances, we are trying to see more clear how the future is, but what we are seeing in front, it's always more uncertainty, and this basically it's delaying the return to much lower prices. The CO2 forward curve, as basically we are seeing, as I mentioned, higher volatility. So right now we are in the lowest point of this new range of volatility. So basically a lower forward curve. And something that we have been saying during the last webinars is that this forward curve was getting steeper. So I tried to find a way to look at this, how we can visualize this. And what I'll be showing in the next slide is the spread between December 2022 and December 2023. So basically seeing how the difference between this point right here, more or less, and this point right here has been evolving. So the higher the difference, meaning the steeper is the curve. And if we look at how this spread has been evolving since this is one year back, basically historically it's been around less than €1, so a very, very flat curve. But since the end of February, beginning of March, this spread start increasing. Right now it's at 3.1%. So basically the steepness of the curve has increased, has basically tripled or fourfold in the last month. So clearly seeing a much steeper curve. I've seen some analysis saying that this level of spread, this 3.1%, is closer to the yield of the 1-year bond of the US government, which is much higher than the German government bond. And the conclusion was that this was a hint, that was an indication that the U.S. investment funds were a large component of this market. But don't quote me on that. I didn't make the analysis, but it's an interesting conclusion, seeing how investment funds are looking for yields similar to the ones that their government are giving them. And looking at the forward curves for power markets compared to 9 weeks ago, basically at the long term, we are seeing no changes. In the short term, we are seeing important increases, mainly in 2023. And for the last quarter of 2022, the current year, we can see the kind of prices that we are seeing, close to 500. I'm not sure if this 900 it's correct or it's 500. I'm not sure. Okay. Anyway, very high prices, except for Spain, because in 2023 until May, for the moment it's until May, we will still have in place the Iberian exception. So prices are really contained and at the level at the price cap that we will have. And okay, just to finish, trying to summarize what we have said and a little bit looking into the future. I had I had a lot of trouble trying to put everything that I wanted in this slide. So basically, I just cut a lot of things. So let's try to see. Basically, gas prices, they are completely, I mean, there's no possible forecasting about that. Everything will go from will be driven by how the flows from Russia are evolving. Probably it's not going to be an easy winter. So highest prices, new peak prices are not ruled out. Probably they will occur again during the winter. But on the bright side, gas reserve levels are at what they were expected. The target was to reach over 80% of the reserve by October, and they are already achieved well in advance. But anyway, full reserve doesn't mean a quiet winter. It's going to be interesting and kind of scary to see how the winter evolves, mainly if we have a cold winter, because then it's going to be tough. What's the European Commission, just the meeting that they had just yesterday, what are the proposals in order to protect consumers for high energy prices, and trying to keep the supply of gas and energy for the winter? Basically, they first were proposing a cap on gas prices, but that was ruled out. And now they are proposing a cap on the prices that the inframarginals technology receives. So basically renewables and nuclear, they want to cap it at 100 euros megawatt hour. So, but this is going to be a posteriori. So in principle, there's for what they look, there's no intervention in the market clearing price. So in principle, market will keep working as they are, but afterwards the earnings of these technologies will be capped at 100 euros megawatt hours. And then they are putting a lot of efforts in order to trying to reducing demand, mainly at peak hours. They are proposing 5% reduction of the gas demand or energy demand at peak hours, and the global reduction of the demand of 10%, I think, if I don't remember. So, well, as I say, it's going to be very interesting how the winter becomes. CO2 prices, increased volatility, but we are not seeing the resuming of the historical upward trend of these prices. And electricity prices, well, basically they have been following the gas prices. The return to the historical levels have been delayed. Now maybe 2026, 2027, and at the longer term, things are kept more or less as they have been for the last years. Mainly prices driven mainly by renewable energy, the production of green hydrogen, and the cost of energy storing. And that's all. Let me finish inviting you to our next webinar. It will be next month, and we will have, as as it is usual in the webinar in October, we will have speakers from Deloitte. So very interesting to talk about the financing of renewable energies. Thank you, Alejandro.
Thank you very much, Oriol. And Jorge, when you're ready, you can change your slides now.
Okay. Good morning to everybody. Just one couple of seconds for me to share my oops. Can you okay.
Now we can see the presentation.
Do you see it now?
Yes, perfect.
Okay. So let me start. Once again, good morning. My name is Jorge Simão. I am Chief Operating Officer of OMIP, the Iberian Derivatives Exchange for power and natural gas. And I will try to, together with my colleague Pablo Villaplana from OMIClear, to give you an overview, quite brief, about our activities, products, services, and what we are doing or can do for the renewables energy, which is the subject of this webinar. First, I will give you an overview of the kind of products that we trade at on our market. Our market is a derivatives exchange, so we provide continuous trading and bilateral registration for OTC trades. And we have quite a comprehensive range of products in power, futures, forwards, and swaps and options. Well, we will come a little bit to this later. We have base, several profiles, base, peak, and solar, and we deliveries. The underlying is for Spain, Portugal, Germany, and France. For natural gas, we have developed physical delivery products and financial delivery products. Those financial delivery products are, the underlying is an index that MIBGAS produces every day. Also, of course, as we need to be a one-stop shop, we provide the regulatory reporting that our clients need in their activities, meaning that remit reporting to ACER and MiFID and MiFIR reporting to the financial regulators. That's the regulated market activities and services. We also have let's say a track record quite long and strong of auctions. We have auctions for renewables, renewable energy, renewable licenses, gas infrastructures, and guarantees of origin. Yesterday, in fact, we had our last guarantees of origin auction. In terms of market model, the market model is a model, let's say, standard in Europe at least, and I think in all over the world, meaning that we are regulated at OMIP. We are a regulated derivatives exchange where we trade the products that I told you, and we are, of course, tightly connected to the CCP, OMIClear. So at OMIP is where trades happen, and at OMIClear where the transactions are registered and the positions are also registered, and of course all the risk management, the collateral management. Pablo will talk about this later. This is seeing some strong restrictions and some evolution, fortunately, that related to the crisis, the recent crisis. So in terms of overall model, we may say that that acting at OMIP and OMIClear, one agent can guarantee price risk mitigation, of course, because it sets a price for its transaction, and also the counterparty or risk mitigation at OMIClear, because as Pablo will explain you, the OMIClear will manage the risk for the positions that are registered at the CCP. Our client portfolio includes members, of course, most of them from the Iberian Peninsula, Spain and Portugal, around 75% from Iberia, 25 abroad from Europe and other continents. They are mainly utilities sector, energy sector entities like retailers, generators, etc., and also brokers, trading houses, etc. So abroad of different interests that smaller agents, bigger agents, that in the end make the market and provide the liquidity that is needed, although that is needed for the market to operate. I will tell you a little bit about the products, the main products in power. We have power, as I told you, for several underlyings. In this slide, only included the Portuguese and Spanish ones. The main products, like I say, is the futures. Are the futures, and in the futures in Portugal and Spain, we have, in terms of maturities, we have from days, we are from days to 10 years. So currently we have listed the year 2032, meaning that our, for example, our years portfolio goes from 2023 to 2032. And in terms of profiles, also interesting, we have profile, the typical, the most traded base load profile. We have peak profiles, and in our case, we have launched some years ago a solar profile that is quite well adapted to the solar generation in Spain, that we call synthetic pay as produce, meaning that with such a profile, generators can sort of set, let's say, a product that matches quite well their generation. We have also recently, in this sense, we have recently launched a contract that we called PPA, meaning that it is a strip of our 10-year contracts listing. So we have a PPA from year 23 to year 2032. We have also 2 5-year PPAs, one starting in the year 23 until 27, and the other one 24 until 28. That is for now. Next year, of course, we will have a PPA 24, 33, and the corresponding 5-year PPAs. Those are interesting because it matches quite well the needs and the contracts that are traded in the industry, the PPA contracts. So it is very, let's say, easy and straightforward to register those contracts at OMIP, OMIClear, to profit from the price fixation and from the counterparty risk mitigation. Let me talk briefly about the liquidity. The recent crisis, the war, has had an impact, a very strong impact on European markets, all over Europe. It's not only Spain. I included on the top, on right side news from, I think, Platts, where they in June they assessed the drop of the liquidity in main European markets. In the Spanish case, the year-to-date value, meaning that it is until last Friday, I think, the volume this year is 56.4 lower than the year before. So it, as you see, it is the liquidity has been reduced very much in this year, and the main fact is the uncertainties and some other motives that we can address later, but mainly uncertainty and also margins that have raised very much with these prices and volatility. Another interesting topic in Iberian Peninsula is that the activity, even the OTC activity, is brought to to CCPs. So the ratio of the clear transactions respectively to the overall activity is very high, higher than 90%, you can say. So it is a characteristic of Iberian market that shows the interest that players pay to the CCP, to the organized markets. Oriol talked a little bit about gas prices. There's some interesting image that slide that I wanted to share with you. If you put on an XY graph gas prices on one side on X axis and the power price on the Y axis, we can say that we have divided time in two periods, one from January 1, 2021 until 15th of June. That is when the Iberian mechanism started, and on the right side of the graph the situation after 15th of June, and you can see that until 15th of June there is a very strong correlation between gas prices and electricity prices. The correlation is 0.97, let's say, but afterwards there is a sort of disconnection between prices of gas and electricity, and the correlation is 0.44, and that is in fact what the government's intended, is that the prices, the power prices disconnect in somehow from gas prices, and this shows clearly that it has happened after after the 15th of June, when the Iberian mechanism started. Oriol already showed some figures about futures price. Here we have the prices for spot front month, front quarter, and front year since January 21, and it is we have several peaks that probably you will know the reasons. Some news about reductions in gas supply from Russia, etc., etc. So all those peaks very much connected to information, market information, and about gas supplies to Europe. So it is now, of course, another interesting feature is that, as you say, as you see, the frontier contract is typically below, was typically below the other maturities. But after the Iberian mechanism entered into force in June, the closest maturities front month and front quarter became more impacted by the mechanism and turned to be lower than the year. And after that, the year contract started to be higher prices than others. Ori also showed forward curve. It is interesting to see that Spain in orange is very below is highly below France and Germany. That in the front, let's say in the short time, in the next years, 23, 24, we can say that it is because of the impact of natural gas and it is more natural gas and nuclear problems in France impact more France and Germany than the Iberian Peninsula. But in the long term, let's say, the curve in Spain remains below France and Germany, and that I think it is because of the impact of renewables being installed in the Iberian Peninsula. Another interesting topic and trend is that in this graph, if you see where we put the two indices that we have, spell-based, which is the average value of prices of power prices in January 2021 until now, and what we call spell solar. It is our solar index, which represents the average, the captured price of solar in Spain. Let's say when we see the absolute prices, they are quite close one to another. But if you add the spread, the bars in green, we can see a trend that goes negative and significantly, which seems to mean that solar is being impacted by the cannibalization effect that is very well known, and I think that it is being to be seen in the Iberian Peninsula since at least the beginning of the year. Also with France and Germany, it's interesting to see how prices develop until let's say beginning of this year. Prices were quite close one to another, but after that, maybe because of the Iberian mechanism, the Spanish price here we have the frontier. The Spanish price is very much lower than the German and the French. On top you have absolute values. On the graph below you have the spreads. The spread is dramatic. We had spreads. You have here the situation, the case of France. For example, the spread for front quarter was 1,660 euros per megawatt, which is something high, very high, and also for the year 1,130 euros per megawatt. Prices in France and Germany, mainly in France, are really very much higher than the Iberian Peninsula. I just because time is running short, I just would like to show you this final slide because to show how we manage the registration of PPAs, financial PPAs, also in the literature known as virtual synthetic PPAs. It is quite simple. We have our PPA for the 10 years. Two agents would register a financial PPA at OMIP for settlement at a price that we call price PPA, euro underscore PPA. This would be before the delivery period. For example, if you have a contract starting in 2023, you should register it in until December 2022. Then during the delivery period from 2023 until 2032, the agent A, which is a seller, would sell on the spot market every day. The agent B and would receive the spot price. The agent B would buy on the spot market and would pay the market price. And after every day also, the CCP, the forward market, would pay them or would settle the difference between the daily market price, the spot market price, and the PPA price. So, if in an example, if you have, for example, 150 euros per megawatt hour contract. If the spot price, for example, is 120, and if you are a producer, you would receive the 30 euros per megawatt for the difference from the forward market. And if the price is 180, sorry, you would give back the 30 euros per megawatt hour to the derivatives market. So you would fix your price of 150. I will now pass the word to Pablo Villaplan, and thank you very much from my side.
Thank you, Jos. Good morning, everyone. Let me just share my screen for a few minutes. I'm not sure. Can you share my? Can you see my? Let me just share again. Sorry. Yeah, this one. Yeah, I think I'm sharing. Can you confirm?
Yes, we can see it now.
Okay. Yeah, much better. Okay, so
perfect.
In these few minutes, I just want to give a couple of ideas on what is a CCP, what's the role of a CCP, and just pointing out what is the discussion currently in energy markets with this stress in liquidity that some market participants are facing, and which are the tools that the European Commission and the CCPs believe that could be used at least to relieve part of this pressure. So as already mentioned, I'm the CEO of OMIClear. I'm also currently quite involved in at the European Institutional Clearing Houses in a new energy clearing working group that could be created. So first of all, what is a CCP? So a CCP is a financial market infrastructure. Okay, so it's a financial institution that basically interposes between a buyer and seller. So basically, a CCP is an entity in which through which once the trade is registered, this trade could be traded in a screen continuous market at OMIP, or could be an originally bilateral contract intermediated through a broker or directly agreed between the parties, that upon registration at OMIClear, automatically OMIClear as a CCP becomes the buyer to reseller and the seller to rebuyer. Okay, so basically we as OMIClear we take the responsibility that the obligations for buyer and seller inherent in that contract are fulfilled. Okay, so basically we eliminate credit risk for the original buyer and seller. Okay, so clearing therefore is the process of guaranteeing that the market transactions are settled and are executed. Okay, the model is basically, in order to participate, it's a bit technical, but buyer and seller do have to join or to relate to the CCP through a clearing member. We at OMIClear have the model, both models. The more typical, that is the general clearing member. So the clearing member is a financial institution, and the trader, so the buyer and the seller, are their clients. It could be the case, obviously, buyer and seller will be different, but it could be the case that the buyer has a clearing member X and the seller has also the clearing member X. Okay, so that generates different type of risk profiles from the perspective of the CCP. But basically here the message is that the trader, buyer and seller has to participate, in order to participate, to register a trade at a CCP, has to have an agreement with a clearing member. Basic model, general clearing member is of an institution. We also have the direct clearing member model, in which only big energy companies with some requisites, I will not enter into detail, could become or could be their own clearer. Okay. So basically what we do, we just register the trades automatically. Once the trade is registered at OMIP for regulatory reasons, it jumps to OMIClear. So basically we register the trade, we establish positions, that is basically sum up the different contracts. So bought 10 contracts and then bought 3 additional contracts and GR+1. So the position is 13 contracts. We calculate the net position and then net margins. We'll back to this in a second. And basically, we have to ensure that there is enough collateral to cover those responsibilities. Okay, responsibilities that assures or that appear basically from the margins that we request for that portfolio. Okay, so that's basically the mechanics in a very simplistic way, the mechanics of a CCP. So basically, by participating in a futures market, market participants reduce market risk, okay, their exposure to spot prices, for instance. By resisting the trade at OMIClear, basically they reduce the credit risk. They do not have a bilateral contract between buyer A and buyer A and seller B, but basically once resisted, the counterparty is OMIClear. Okay, this has some advantages. So basically, in a very quick way, so in a pure bilateral market, so will be on the left. There is a network of relationships between all these members, A, B, C, D, F. This means that, for instance, if you are new into the market, you have to sign, maybe not with 50, 60, or 100 market participants in the market, but just at least a relevant number of market participants. So in order to participate in the market, in this bilateral market, you should sign or you should have some relationship, master agreement, guarantees, etc., with some market participants. If you go to the right and you become a member of OMIClear, so basically automatically by being member at OMIP and OMIClear, or in the gas market also OMIP, MIP gas and OMIClear, basically you automatically you can trade with any of the other counterparties that are also members of OMIClear, of the CCP. So this facilitates a lot access to new market players. So the fact that there is a CCP. Another issue is in a network, so in a pure bilateral market, that there is a network of relationships. Basically, there is a lot of, there is a risk of contagion. Okay, so the default of a member A may affect member B, member C, whatever, or even you can have second round effects. So member A and D are not related, but maybe D and B do have close relationship, volume of trades, and then the original default of a member could affect the other ones. Okay. While in a model where you have a CCP, basically is the CCP that is reducing, eliminating the risk of contagion, because basically we, at the CCP, bear the risk of a default of one market participant. Okay. There are other advantages. So basically, as I said, CCP allows to reduce or to manage credit risk. You have a bilateral relationship. You have a relationship with the CCP. As I said, facilitates access to new market players, reduce contagion risk, and then basically also by settling all the positions or by aggregating all the positions in the CCP, basically there is a unique settlement process. You don't have to pay to B, D, F and receive from E, for instance, but basically all is settled at once in a moment of time and at the same in aggregated way when you work with a CCP. If we are talking about physical settlement, is also a CCP, for instance, in gas market that is more usual. Is always the CCP that will manage the physical settlement of the contract by notification to the TSO. So, conceptually speaking, these are the two simplistic worlds. Obviously, they cohabit. You can have bilateral trades, but also trades registered at the CCP. But this is basically the two main, the main characteristics or two main type of models you have in the market. So in order to do that, what CCP does, basically, you can obviously every CCP will explain different way, but basically the two main measures or tools let's say it's mark to market and initial margin. Okay, we also there is credit risk evaluation, and there's also a default waterfall, but basically a clean fund. But basically, the two main measures is mark to market and initial margin. Okay, so let me just very briefly mention what is going on in the market right now and what are the measures that the European Commission is analyzing in order to reduce liquidity stress to market participants. So first of all, with initial margin, basically just to mention that initial margin will depend on the contract. So as Oriol and also George has shown, we have seen that faraway contracts, so year plus 4, year plus 5 contracts, we have much lower volatility. And that means that any CCP will request a lower initial margin for a 5 years ahead contract than, I don't know, month ahead contract that are much volatile. So basically initial margin, the regulation imposes that it should be an amount of collateral that allows the CCP to close the position in case of a default in a certain period of time, a few days. Okay, so basically in a CCP, what you have in your initial margin model is some kind of a statistic, mathematics, and you have also some issues on liquidity, but basically a statistical model to simplify, in which you take the volatility of the contract, and then you see what is the potential evolution of prices, the potential future exposure that the CCP will have if it has to be to close the position of a defaulter. Okay, and the closure of that position has to be done in very few days, as established in the regulation. So what has happened in the last, I mean, since summer 2021 or in this year? So basically, we have seen that there is volatility of huge volatility of prices. On the upper part of the picture, you have electricity prices, and in blue you have natural gas prices at PV in Spain. Okay, so basically, with the two measures that I was mentioned, mark-to-market and initial margin, there has been two effects. On one hand is that the mark-to-market, in a very simplistic way, basically it means that the CCP will compute the price difference between yesterday's price, end of day price, and today end of day price. So when we have had these spikes, in this case when the price was increasing, basically on that day the CCPs are requesting a huge amount of money. So this price difference, in this case to buyers and sellers, but basically they will have negative mark-to-market for sellers. So sellers do have an obligation to deliver, let's say, the commodity, for instance, 250 euros, okay? And the day after, this same future contract has a price of 325, just to say a number, okay? So that means that the incentive for sellers to default, not to comply with the contract, are huge, because the market is valuing that contract at a higher price. So through mark-to-market, the CCPs kill these incentives, and they will request the difference between these 250 and 325. This is the mark-to-market amount that basically will pass from the sellers, in this case, to buyers. But the point is that once we have a spike, a few days later, basically the prices jump down, decrease quite abruptly, and then the mark-to-market is requested. I mean, the mark-to-market calculation means that the amount of money goes from buyers to sellers. Okay, so this is part of the liquidity pressure. And obviously, given the volatility, as I mentioned, if the initial margin is, simplistic way, a measure of the volatility of prices at a 5 days horizon, 2, 3, 5 days horizon, basically the amount of the increasing volatility has also meant that the initial margin at the CCP has increased. Okay, so this has generated a lot of pressure. This is obviously quite well known on liquidity of market participants, and there are some movements, let's say, some lobby actions performed. For instance, we just published a letter quite recently, European clearinghouses, IFE, Electric and Europex. So because we see that one possibility to reduce this cash liquidity pressure on market participants would be to increase the collateral that CCPs can accept. Currently, the point is that basically CCPs we can only accept as collateral either cash or bonds. Okay. In the past, and we were one of the CCPs that were doing that, the regulation allowed us to also accept as collateral bank guarantees. So here the discussion, as you can see, as discussion as recent as yesterday, is how the European Commission and ESMA will react to this request. And what we have to see in the coming weeks, coming months, is to see if regulation allows CCPs to accept bank guarantees, on-demand bank guarantees. And this potentially could have a relief effect, or can reduce the liquidity pressure that market participants do face currently, just by given the volatility of prices, either through the mark-to-market mechanism or through the initial margin models that are quite connected to the volatility of futures prices, both in electricity and gas. So I was, in order to just finish at the scheduled time, that would be my my comments. And I don't know if there is any question or either from market participants or from AleaSoft. So I will just leave it here if you agree.
Thank you very much, Jorge and Pablo, for that insightful presentation. And thank you again for sharing this webinar with us. So yeah, we will start now the Q&A menu, the Q&A section of this webinar. And since we are already out of time, we will answer only a couple of questions. Uriol, I see that you already have a question selected.
Yes, I have a question. So really quick, it says, so gas prices cap for Iberian Peninsula provides a real advantages. Why not apply it to the all EU countries, in particular capping the price towards Russia? Well, yeah, as data, you can see in the data by yourself, clearly the gas price cap in the Iberian exception works, but it's important to notice that it's different from what the EU was proposing at the very beginning. It's the price cap in the Iberian Peninsula is not a cap on the imported gas, so it's not a cap on the gas that we are buying. We are buying the gas at the same price, but there's a cap on the gas price that gas power plants are using in order to make market offers. So market offers made by the gas plants are using a capped gas price. But after the market, those gas plants has to be compensated because they are selling energy way below their production cost. So, but in this way, we are only compensating gas plants, and while inframarginal technologies are just receiving the market price that is much lower. So in a way, it's similar to what the EU is proposing, that is reducing the revenues that the renewables and nuclear are receiving. So it's basically the same, but done in another way. So we are not capping the price, the gas prices that we are paying as the gas that we import. We are just offering the gas to the electricity market much lower, and afterwards compensating power plants. So it's not exactly the same. At the end, what the EU is proposing and what we are doing in the Iberian exception, it's more or less the same, but done in a different way.
Okay, perfect. So that concludes the webinar today. And as Oriol mentioned, I invite you to register to our next webinar in October, and we will have guest speakers from Deloitte for the third consecutive year, analyzing these interesting topics that I'm showing. So thank you again, Uriol, Jorge, and Pablo for your presentations, and the audience for joining. Have a nice day.